Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 2. And Chapter 2 is all about the accounting process. In today's lesson, there are five key areas that I'm going to be highlighting today. First, we have the accounts. Second, we have the transaction analysis using accounts. Third, we have the trial balance. Fourth, we have the formal accounting records. And finally, we have the accounting cycle. And so, for that matter, let us discuss first our first key area, which is accounts. Now, chapter 2 looks more closely at assets, liability, and owner's equity accounts by double entry accounting, namely the debits and the credits. Now, the transactions introduced in chapter 1 for Big Dog Car Works Corporation are used to explain debit and credit analysis. The preparation of a trial balance will be introduced as well. Now, additionally, this chapter will demonstrate how transactions are recorded in a general journal and posted to a general ledger. And finally, the concept of the accounting cycle is being presented. Now, chapter 1 reviewed the analysis of financial transactions and the resulting impact on the accounting equation. Now, we now expand that discussion by introducing the way transaction is recorded in an account. So, what is meant by an account then? Well, if we say account, it accumulates detailed information, the increases and decreases in a specific asset, liability, or equity item. Accounts are maintained in a ledger, also referred to as the books. Now, at this point in time, we will now review and expand our understanding of asset, liability, and owner's equity accounts. Now, we need to recall that assets are resources that have future economic benefits for the business, right? Now, the primary purpose of assets is that they be used in day-to-day operating activities in order to generate revenue either directly or indirectly. And note that a separate account is established for each asset. Now, as you can see, there are a couple examples of assets, and these examples are the following. First, we have cash, and cash is divided into four. We have cash on hand, cash in bank, cash in fund, and we also have cash equivalent. And aside from cash, we also have accounts receivable, notes receivable, inventory. We also have prepayments, and there are divisions as well of prepayments. We have prepaid rent, prepaid advertising, prepaid insurance, and many others. Aside from these, we also have land, building, furniture and fixtures, and under furniture and fixtures account, we have chairs and tables, air conditioners, cabinets, electric fans, desks, bookcases, and partition, and there are a lot more. And aside from that, we also have office equipment, and under office equipment account, we have computer, typewriter, fax machine, photocopier, telephone units, and store equipment, and a lot more. And finally, we have delivery equipment as well. Now, in order for us to better understand each of these accounts, let us discuss them one by one, starting with asset accounts. So specifically, we have cash. So what is meant by cash? If we say cash, it is a generic account, meaning to say some companies that engage in simple transactions usually use this account, which could either be on hand or in the bank. However, for a company to be more effective in directing its business, cash can be made more specific. Now, the following are the specific names of cash used in academic field as well as in the industry. So we have cash on hand. For the cash on hand, it denotes money or cash substitutes representing the collection of the company awaiting deposit to the company's depository bank the following banking day, or of the company has collection on non-banking day, it has no choice but to wait for the next banking day. And aside from cash on hand, we also have cash in bank. And cash in bank denotes to the money of the company that is in the bank awaiting payment. Now, if some companies maintain several bank accounts, an additional description representing the name of the bank appears. And so, for this matter, it is highly suggested that when you use the account in the journal entry, you have to include the name of the bank. For example, we have BDO, cash in bank, or BPI, cash in bank. So it should be specific. And also we have cash in fund. For cash in fund, it denotes money placed in a specific fund for a specific purpose. One example for this is the petty cash fund. Now, this is the fund intended to pay for petty expenses. Now, this is very helpful, especially that the company cannot issue a check for small expenses, correct? Now, in order for us to better understand what a petty cash fund is, let me give you an example. So, for example, you ask your employee to buy office supplies. Okay. Now, in buying office supplies, your employee spends cash for the jeepney fare. Now, it obviously means that we cannot issue a check as payment to the jeepney driver, if that makes sense, right? Therefore, what we usually do is we get cash from the petty cash fund. All right. Now, finally, we have cash equivalent. And if we say cash equivalent, it refers to short-term investments by the company. It is generally accepted that only accounts under 3 months maturity will be considered on this account. So that is one example of an asset account. We have cash. Aside from cash, we also have accounts receivable. So what do we mean by accounts receivable? If we say accounts receivable, it refers to customers' account arising from selling activities. So this account to a trade account receivable. And this usually occurs if your customers did not buy on cash, meaning to say they bought your products on credit. And so for this matter, you have receivables or you have collectibles from them. So that is why we call it accounts receivable. All right. And next we have notes receivable. So if we say notes receivable, this refers to the account receivables or collectibles of a company and is supported by a promissory note. So there is an attachment to it, okay? And that attachment is a promissory note coming from your customers, maybe, or suppliers. And also we have inventory account. For inventory, this refers to the merchandise of the company intended for sale in the course of its business operation. So these are your stocks in your company. So we call them inventories. And also we have prepayments. If we say prepayments, these are advance payments made by the company. For example, if the company paid rent in advance for a year, then the advance payment is called prepaid rent, okay, since you made an advance payment. On the other hand, if we pay in advance for advertising, then the advance payment is called prepaid advertising, all right? And next we have land. And this refers to the land owned by the company that is being used in the business. And take note that land is the only asset of the company that will never depreciate. So what do you think is the reason why land will never depreciate? Now, the reason is because the usage is infinite or endless. So that is why it will never depreciate. Its value will never depreciate. Another example of asset that would be building. And this refers to the infrastructure owned by the company that is being used in the business. And also we have furniture and fixtures. So for furniture and fixtures account, these refer to movable furniture and fixtures that have no permanent connection to the structure of a building. Okay, examples that would be, we have chairs and tables, air conditioners, cabinets, electric fans, desks, bookcases, and we also have partitions. All right. So these are just some of the many examples of furniture. Again, these are movable furniture and fixtures that have no permanent connection to the structure of a building. Next, we have office equipment. So these are long-term assets reported on the balance sheet under the heading of PPE, or property, plant, and equipment. And examples of office equipment, we have computer, typewriter, fax machine, photocopier, telephone units, store equipment, and a lot more. All right. So these are just some of the many examples under office equipment account. And finally, we have delivery equipment. So this is the account that is used, or that is usually used instead of transportation equipment sometimes. All right. So these are our examples under asset accounts. Now let's move on to our liability accounts. Now, as explained in chapter 1, a liability is an obligation to pay for an asset in the future. Now, the primary purpose of liabilities is to finance investing activities that include the purchase of assets like land, buildings, and equipment. Now, liabilities are also used to finance operating activities involving, for example, we have accounts payable, unearned revenues, and wages payable. So a separate account is created for each liability. So examples of liability accounts, we have accounts payable, wages payable, short-term notes payable, long-term notes payable, and we also have unearned revenues. Now, in order for us to better understand each of them, let us discuss them one by one, starting with accounts payable. So what do we mean by accounts payable then? If we say accounts payable, it represents the liability account of the company arising from purchase of merchandise that is intended for sale. So meaning to say, supposing you want to buy or to purchase a new equipment, okay, for the production of your products. And when you went to a certain store, let's say in SM department store, you found the equipment that you wanted to buy. However, you did not buy it on cash. Instead, you buy it on credit. So meaning to say, that is considered as accounts payable. That is a debt obligation that you need to pay in the future. Okay, so that's what we call accounts payable. Another, we have wages payable. So if we say wages payable, these are wages owed to employees for the work performed. Now, if we say wages payable, these are the salaries of the employees that have not received by the employees as of yet. Meaning to say, the company or your company did not give out the wages or salaries of your employees as of yet, because your payday falls under every 15th and 30th of the month. However, today is just, let's say, the 8th of the month, and you still have 1 week before you pay the salaries and wages of your employees. So that means to say you still have payable to them, okay? You still have payable to the work that we have rendered from the cutoff period, all right? Next, we have short-term notes payable. And if it's a short-term notes payable, these are a debt owed to a bank or other creditor that is normally paid within a year. Okay? Take note that that is normally paid within a year. So you made a loan from a bank, maybe, or from any other financial institution that is payable within a year. And notes payable are different than accounts payable in that notes involve interest. All right. So these involve interest because if you would like to get a loan from a bank, of course, you will be paying for an interest as well because that is how banks or financial institutions make income. So they call that as interest income. All right. So next we have long-term notes payable. If we say long-term notes payable, these are a debt owed to a bank or other creditor that is normally paid beyond 1 year. Again, if short-term notes is within a year, for long-term notes, meaning to say you need to pay your loan obligation beyond a year. So it may be 2 years or more. So like short-term notes, long-term notes also involve interest. All right. And next we have unearned revenue. So these are payments received in advance of the product or service being provided. In other words, the business owes a customer the product or service. That is why it's called unearned revenue. These are the examples under liability accounts. So moving on to our equity accounts. But as you can recall in chapter 1, we also learned that equity represents the net assets owned by the owners of a business, right? So in our corporation, the owners are called shareholders, and equity is traditionally one of the more challenging concepts to understand in introductory financial accounting. The difficulty actually stems from there being different types of equity accounts. So we have share capital, retained earnings, dividends, revenues, and expenses. So these are the types of our equity account. And as you can see, in figure 2.1, this shows the composition of equity accounts. So as you can notice, equity is divided into two parts. First, we have the share capital, and we also have the retained earnings. And retained earnings is further divided into three as well. So we have dividends, we have revenues, and we also have expenses. Now recall that revenues less expenses equals your net income, meaning if your income is more than zero, then that is net income. But if it's less than zero, meaning negative, that's net loss. So net income or net loss is not an account, but is the result of subtracting expenses from revenues. And in order for us to better understand each of these equity accounts, let us discuss them one by one, starting with share capital. Now, if we say share capital, simply, it represents the investments made by owners into the business and causes equity to increase. So, for example, if I am the owner of ABC company and I invested 100,000 pesos, then that is what I call share capital. That refers to the investment made by the owner. And also, we have retained earnings. If we say retained earnings, this is the sum of all net incomes earned over the life of the corporation to date, less any dividends distributed to shareholders over the same time period. And therefore, the retained earnings account includes revenue, dividends, and expenses. Now, in other words, dividends, these are the portion of profit after tax that is given out to shareholders and stockholders. And whatever is left is what we call retained earnings. And these amount of money are kept by the company for future expansion purposes. Okay, so that's a difference between dividends and retained earnings. And of course, we also have revenues and expenses as well. All right, so these are the examples of the accounts under equity accounts. Now, moving on to our subtopic, we have T account. Now, what is meant by T account? If we say T accounts, these are simplified accounts that are often used as a teaching or learning tool to show increases and decreases in an account. So it is called a T account because it resembles the letter T. Now, as you can see in our sample T account, the left side records the debit. So the debit is always on the left, and the right side records the credit. So the credit is always on the right. Now, as you can see, we also have what we call account balance. And if we say account balance, it is actually determined by adding and subtracting the increases and decreases in an account. Now, as you can see in our example, the $3,700 debit balance, okay, in my left side corner, if you can notice that, in the cash account was calculated by adding all the debits and subtracting the sum of the credits. Now, take note, the $3,700 is recorded on the debit side of the T account because, okay, the debits are greater than the credits. So in accounts payable, the balance is $4,300, right? And this is under credit side, calculated by subtracting the debits from the credits. Now, since, as you can notice, 5,000 is higher than 700, that is why 4,300 is in line with 5,000. So meaning to say it was under credit side. Now, notice that cash shows a debit balance while accounts payable shows a credit balance. Now, the cash account is an asset, right? So its normal balance is a debit. So what is meant by a normal balance then? So if we say normal balance, it is the side on which increases occur. Now, accounts payable is a liability, and because liabilities increase with credits, and therefore, the normal balance in accounts payable is a credit, as shown in our T account example. And on our next subtopic, we have chart of accounts. And if we say chart of accounts, these refer to a list of accounts where each account is assigned both a name and a number. Now, a common practice is to have the accounts arranged in a manner that is compatible with the order of their use in financial statements. Now, as you can see in the presented example, asset accounts begin with the digit 1, liability accounts with the digit 2, share capital accounts begin with digit 3, revenue account begins with digit 4, and expense account begins with digit 5. Now, take note that each business will have a unique chart of accounts that corresponds to its specific needs. Now, in this case, this is the numbering system that Big Dog Car Works Corporation uses in its account. All right. So the next key area that we're going to be discussing right now, that would be transaction analysis using accounts. Now, if you can recall in our chapter 1 discussion, transactions for Big Dog Car Works Corporation were analyzed to determine the change in each item of the accounting equation. Now, in this chapter, we will use these same transactions to demonstrate double entry accounting. So what do we mean by double entry accounting then? Well, as we learned in chapter 1, double entry accounting means each transaction is recorded in at least two accounts where the total debits always equal to total credits. Now, as a result of double entry accounting, the sum of all the debit balance accounts in the ledger must also equal to the sum of all the credit balance accounts. Now, the rule that debits equals credits is rooted in the accounting equation, which is assets equals liabilities plus owner's equity. Now, just a brief recap. If we say assets, these refer to those resources controlled by the entity as a result of past transactions or events and from which future economic benefits are expected to flow to the entity. On the other hand, if we see liabilities, these are the present obligation of the entity arising from past transactions or events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. And finally, we have owner's equity or capital. This is the residual interest in the assets of the entity after deducting all of its liabilities. And remember that there are four components of capital, and these are investments, also known as capital account. Second, we have withdrawal. Third, we have revenues. And finally, we have expenses. Now, if we say investments or capital, this is the resource that the owner has transferred to his business as a startup additional. And our investment will increase our capital. Now, this may be in the form of cash or tangible assets that can readily be used in the business. For example, we have the land, building, furniture, equipment, etc. Okay, next we have withdrawal. This is the temporary withdrawal of the owner, whether cash or any other assets of the company for personal use. And withdrawals or drawings will decrease our capital. Next, we have revenues. And if we see revenues, these are the increase in economic benefit during the accounting period in the form of inflow or increase in assets or decrease in liability, which results in increase in equity other than contribution from equity participants. And our revenues will increase our capital. And finally, the last component of capital is expense. And expense is the decrease in economic benefit during the accounting period in the form of outflow or decrease in assets or increase in liability, which results in decrease in equity other than distribution to equity participants. And our expense will decrease our capital. Now, if we take a look at the capital, there are two components which will increase capital, and these are our investments and our revenues. On the other hand, the two components that will decrease our capitals are withdrawals or drawings and expenses. Therefore, for the purpose of determining the normal balance of the account, the equation will be presented as follows. Now, it is very important that as a learner, you should know the normal balance of the account. But what is meant by the normal balance of the account? Now, if we say normal balance of the account, it is the increase side of the account. And therefore, if there is an increase in the company's assets, drawings, or expenses, then you have to debit the account. Conversely, if there is a decrease in company's assets, drawings, and expenses, you have to credit the account. Now, this is the same way with the other side of the equation. If there is an increase in liabilities, investments, and revenues, then we have to credit the account. Otherwise, we need to debit it. Okay. Now, as you can see on the tabulation, assets can be found on the left side of the account. So this is the left side of our T account, and therefore, this is debit. On the other hand, our liabilities and capital, these are the right side of the T account, and therefore, this is credit. Now, on matters of analyzing a transaction, whether the account will increase or decrease, then it is imperative to learn the basic rule on when to debit and when to credit. Now, the reason we need to learn when to debit and when to credit is because this is one of the basic issues in accounting. And as you can see on the presented tabulation, when a transaction causes our assets, expenses, and drawings to increase, then we have to debit our account. May it be an asset account, an expense account, or a drawing account. However, if the transaction causes assets, expenses, and drawings to decrease, then we have to credit our account. On the other hand, when a transaction causes liabilities, capital, and revenue to decrease, then we have to debit the account. However, if the transaction causes the increase of liabilities, capital, and revenue, then we have to credit such accounts. Therefore, in order to avoid committing error regarding debit and credit, then we need to be familiar with the rule and stick with it. Now, we will summarize the rules of debit and credit in the following matrices or models. Now, we have 6 models in order to be able to summarize the rules of debit and credit. And the first model that we have is increase in asset and increase in capital. Now, in this case, the components of capital which will increase, that would be our investment. Now, in order for us to better understand model number 1, let us have an example. But before giving the example, this is how our figure looks like for model number 1. So as you can see on the figure, this is how model number 1 looks like. As you can notice, we are using accounting equation, which is assets equals liabilities plus capital. Okay, so going back to model number 1, it states increase in asset, increase in capital, which is our investment. Now, in terms of assets, it will obviously increase. And in terms of liabilities, can you see any liabilities in model number 1? No. Therefore, it has no effect on liabilities. And finally, on the capital side, it will increase specifically the investment. Now, under model number 1, usually the examples under this type of transaction is the investment of the owner, whether initial or additional investment. Now, in order for us to better understand model number 1, let us have an example. Example, Paul, the owner, opened up a business enterprise with a trade name of VNR Services and invested 100,000 pesos in cash into the business. Now, in the previous chapter, we discussed about the accounting cycle, right? And we learned that accounting cycle is comprised of 10 steps. And the first step in the accounting cycle is data gathering or transaction analysis. And so for this matter, applying the steps of accounting cycle, the first thing that we need to do is to apply step number 1, and that is data gathering or transaction analysis. Now, in analyzing our transaction, there are actually three ways to do it. First, we need to determine the accounts involved in the given accounting problem. Second, we need to determine the effects of each account towards our assets, liabilities, and capital. And finally, we need to evaluate if we debit or credit the said accounts involved. Now, going back to our problem, Paul, the owner, opened up a business enterprise with a trade name of VNR Services and invested 100,000 pesos in cash into the business. Now, if we try to analyze the problem, it is very clear that there are two accounts involved. First is the cash worth 100,000 pesos. And second, as you can notice, there is a word invested in our problem, right? So, meaning to say, the 100,000 pesos was invested by Paul to his business, and therefore this is capital. And so you can recall there are two sample accounts under capital account. First, we have X capital, and second, we have X withdrawal. And remember, X refers to the name of the company owner, and therefore our second account involved is Paul capital. So this is the first step in analyzing the transaction. Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will increase our asset since basically the company received 100,000 pesos in cash. On the other hand, there will be no effect on the liabilities. And lastly, it will increase our capital since Paul, the owner, invested money into the business. Now, this ends our second step. Now, the last step in analyzing a transaction is how we treat our asset account and capital account. And so for this matter, we will ask ourselves which account will be debited and which account will be credited. Now, in order to answer this question, it is imperative to go back to the basic rule as to when to debit and when to credit. Okay, going back. Okay, so this is our basic rule as to when to debit and when to credit. Now, based on the rule, if we increase our assets, expenses, and drawings, we need to debit the account. Otherwise, we credit it. On the other hand, if we increase our liabilities, capital, and revenue, we credit the account. Otherwise, we debit it. Now, since cash is an asset, okay, so we will encircle our asset, and therefore, since this asset rather will increase. On the other hand, since Paul Capital is a capital account, so as you can see on the tabulation, we encircled capital because Paul Capital is under capital. And since Paul Capital will increase our capital, so we encircled increase, and therefore we will credit the account. Okay, so this is the first step in accounting cycle. We gather data gathering or transaction analysis. So what we did, we just analyzed our transaction. Now, the second step in the accounting cycle is to do journalizing or journal entry preparation. So how do we journalize then our transaction? Now, before getting into that, this is our finalized tabulation. So what we did on our asset cash, we debit the cash. And what we did on our capital, Paul Capital, we credit Paul Capital. Now, in journalizing, so this is how our journal entry preparation looks like. So under debit, you have cash, 100,000 pesos. And under credit, you have Paul Capital, 100,000 pesos. And after that, there should be a brief description of the transaction. Okay, so our brief description in this case, that would be to record the investment of Paul. Okay, so moving on to model number 2. Now, our model number 2 is increase in assets, increase in capital. So in this case, the component of capital which will increase is our revenue. Now, in order for us to better understand model number 2, let us have an example. So, for example, VNR services rendered services to customers amounting to 50,000 pesos. Now, apparently, in this problem, VNR Services is the name of the company, and obviously, it's a service industry as well, since it rendered services to its customers. Now, the first step in analyzing our transaction is to determine the specific accounts involved. Now, based on our problem, as you can notice, there are two types of accounts involved. First is cash receivable, and second, we have service income. Why cash receivable? Cash receivable, it's because the company rendered services to its customers amounting to 50,000 pesos. However, we have not received such amount as of yet. It is still a collectible of the company. So that is why it's considered cash receivable. On the other hand, we also have our second account, service income, because that will become an income of the business itself, which is VNR services. Okay, now the second step is to determine the effects on towards our assets, liabilities, and capital. So in this case, it increases our asset, no effect on our liability, and it increases our capital as well. Now, the last step is how we will treat these accounts. Now, going back to the basic rule, since cash is an asset, so we will encircle asset, and since our asset cash will be increased, and therefore we will debit cash. On the other hand, since service income is under capital, and so we will encircle capital, and since our capital will increase, and therefore we will credit the account. Okay, so this is step 1 of the accounting cycle, transaction analysis. So moving on to the second step in the accounting cycle, the journal entry preparation. But before going over into that, this is how our finalized tabulation looks like. Again, as I said earlier, our cash receivable should be debited. Our capital service income should be credited. Now, this is how our journal entry preparation looks like. Now, under debit, you have cash receivable, 50,000 pesos. And under credit, we have service income, 50,000 pesos. And therefore, our brief description, that would be to record the services rendered for cash. Okay, so this ends our discussion for model number 2. Now, moving on to model number 3. Now, model number 3 is increase in asset, increase in liability. Now, as you can see on the figure, there is an increase in the assets, increase in the liability, and no effect on the capital. And so, for every increase in asset, there will also be an increase in liability. Now, in order for us to better understand this model, let us have an example. For example, VNR Services borrowed money from Bank X amounting to 300,000 pesos to finance its operations. Now, the first step that we need to do in order to solve this transaction is to analyze our transaction itself. Now, we need to analyze the transaction in order for us to determine the specific accounts involved. And as you can notice, there are two accounts involved in our problem. First, we have cash, and second, we have loans payable. Now, loans payable because you borrowed money from bank X, meaning you owed money from the bank. And since it's a loan that needs to be paid, so that is why our one account is loans payable. Another account that we have is cash, because when you loan that money, your company received 300,000 pesos in cash. And so that is why our second account is cash. Now, the second step in analyzing the transaction is to determine the effects of each account towards our assets, liabilities, and capital. And so in this case, our cash will increase our assets, since basically the company received 300,000 pesos in cash as it loaned money from the bank. On the other hand, our loans payable account rather will increase our liability, since it's a debt obligation that we need to pay. And lastly, there will be no effect on our capital account. And finally, the last step in analyzing the transaction is how we treat our asset account and liability account. Now, the question now is, which account will be debited and which account will be credited? Now, in order for us to better understand or answer this question, rather, it is imperative to go back to the basic rule as to when to debit and when to credit. Now, based on the rule, if we increase our assets, expenses, and drawings, we need to debit the account. Otherwise, we credit it. On the other hand, if we increase our liabilities, capital, and revenue, we credit the account. Otherwise, we debit it. Now, since cash is an asset, so we will encircle asset. And since we increase our asset cash, so we will encircle increase. So that is why we need to debit the account. On the other hand, since loans payable is a liability, so we encircle liability. And since our liability will increase, and so for this matter, we will credit the account. So this is how our finalized tabulation looks like. So what we did on our asset cash, we debit it. And what we did on our loans payable liability, we credit it, okay? So this is how our journal entry preparation looks like. Under debit, you have cash, 300,000 pesos. And under credit, you have loans payable, 300,000 pesos. And the brief description should be to record the proceeds of loan from Bank X. Okay, so this ends our discussion on model number 3. Moving forward to model number 4. Model number 4 is decrease in assets, decrease in capital. Now, as you can see on the figure, there is a decrease in assets, no effect on liability, and a decrease in capital. And so for every decrease in asset, there will also be a decrease in capital. Again, that is not a decrease in liability. Instead, that's a decrease in capital. Now, in order for us to better understand this model, let us have an example. Example, V&R Services paid rental expenses for the month amounting to 4,500 pesos. Now, the first step that we need to do in order to solve this problem is to analyze the transaction. We need to analyze the transaction. Like I said earlier, it is in order for us to determine the specific accounts involved. Now, if we try to comprehend the problem, there are actually 2 accounts involved. First, we have cash, and second, we have rent expense or rental expense. Why cash? Cash because we let a certain amount of money out from our pocket. And also, rent expense because our rental is already due and that we need to make a payment for it, okay? Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will decrease our assets since, like I said earlier, we let 4,500 pesos cash out from our pocket. And therefore, there was an outflow of our asset. On the other hand, our rent expense will decrease our capital and there will be no effect under liability. And finally, the last step in analyzing the transaction is how we treat our asset account and capital account. Now, the question now is, which account will be debited and which account will be credited? Now, in order for us to answer this question, it is imperative to go back again to our basic rule. Now, based on the rule, if we increase our assets, expenses, and drawings, what do? We need to debit the account. On the other hand, if we increase our liabilities, capital, and revenue, what do? We credit the account. Otherwise, we debit it. Okay. Since cash is an asset, so we insert called asset, and since our asset will decrease, therefore, we will credit the account. On the other hand, since our rent expense is a capital, so we will insert called capital, and since our capital will decrease, and so for this matter, we will debit the account. So this is how our finalized tabulation look like. So our cash will be credited and our rent expense will be debited. And so for this matter, this is how our journal entry preparation looks like. So under debit side, we have rent expense, 4,500 pesos. And under cash, we have under credit side, we have cash, 4,500 pesos. And the brief description, to record payment of the rental for the month. And finally, we have model number 5. And model number 5, decrease in asset, decrease in liability. Now, as you can see on the sample figure, there is a decrease in assets, decrease in liability, and no effect on capital. So for every decrease in asset, there will also be a decrease in liability. Now, in order for us to better understand model number 5, let us have an example. For example, VNR Services paid its loan account with Bank X amounting to 300,000 pesos. Now, the first step that we need to do in order to solve this problem is to, again, we need to analyze our transaction. We need to analyze the transaction in order for us to determine the specific accounts involved. Now, based on the given example, there are actually 2 accounts involved. First, we have cash, and second, we have loans payable. Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will decrease our assets since, like I said earlier, we made a payment on our loan and therefore there is an outflow of our asset. And aside from that, our liabilities will also be decreasing. So it will decrease our liability since we already made a payment, a portion of our total loan, okay? So we made a payment since our loan was already due. So there will be a decrease in our liability. And again, there will be no effect on our capital. And so how do we treat our transactions then? So which account will be debited and which account will be credited. Now, in order for us to better answer this question, we need to go back to the basic rule. Now, as you can see on the basic rule, when to debit and when to credit tabulation, since cash is an asset and our asset decreased, so that means to say that we need to credit our asset cash. On the other hand, since loans payable is a liability, and since our liability decreased because we already made a payment of a portion of our total loan, and therefore, that means to say that we need to debit our liability loans payable. Okay, so this is how our finalized tabulation looks like. So again, what do we do with our cash? We need to credit it. And how do we treat our liability loans payable? We need to debit it. So this is how our journal entry preparation looks like then. So under debit, we have loans payable, 300,000 pesos. And under credit, we have cash amounting to 300,000 pesos. And our brief description should be to record the payment of loan from Bank X. At this point, let me provide you another illustrative examples, and take note that these examples, we are now more focused on the Big Dog Car Works Corporation, like what we had in Chapter 1. We also made use of the company Big Dog Car Works Corporation. Now, as you can see in Transaction 1, it says a January 1 transaction, Big Dog Car Works Corporation issued 1,000 shares to Bob Baldwin, a shareholder, for a total of $10,000 in cash. Take note that the very first thing that we need to do if we are given an accounting transaction is to analyze the transaction. Now, if we try to analyze our transaction, how many accounts do you think are involved in our first transaction? Well, we have asset account, and we also have share account. Now, as you can notice in our debit side, an asset account, we call that cash, is increased, resulting to a debit. Well, our cash account increases because, like I said earlier, Bob Baldwin, who happens to be a shareholder of Big Dog Car Works Corporation, invested a total of $10,000 in cash. So the corporation technically received $10,000 in cash. Okay, so that is why the cash of the corporation increases. On the other hand, for the credit side, you have share capital. This is an equity account, okay, and it is increased, resulting in a credit. So the moment you received the $10,000 in cash, it also increases your share capital, okay? Like we defined earlier, share capital refers to the investment of the owner of the company. All right, so take note, an alternate analysis would be that the issuance of shares causes equity to increase, and increases in equity are always recorded as a credit, okay? So the next transaction we have, 2nd of January, borrowed $3,000 from the bank, meaning to say Big Dog Car Works Corporation made a loan from the bank. So if we try to analyze the transaction, how many accounts do you think are involved? Okay, so same with transaction 1, we also have 2 accounts involved for this particular transaction. First, we have cash, okay, and second, we have bank loan. Now, as you can see in our debit account, an asset account called cash is increased, resulting in debit. Now, why cash increased? Because we made a loan from the bank. So when we made a loan, and when our loan was approved by the bank, we received $3,000 in cash. Okay. And for the credit side, this is a liability account called bank loan is increased, resulting in a credit. So why is it that bank loan account also increased? Because remember, you made a loan to the bank, meaning to say, you will now be having a debt obligation to them. Okay, so that means to say that you have an obligation to pay. So that's what we call bank loan. So your liability also increased. So that means your bank loan. And third transaction happened on the 3rd of January. Equipment is purchased for 3,000 in cash. Okay. So if we try to analyze these transactions, how many accounts do you think are involved for this particular transaction? Well, there are two accounts involved. First, we have equipment, okay, and second, we have cash. Now, as you can see in our debit side, one asset is acquired in exchange of another asset. What do you think is the other asset acquired? Okay, the asset acquired by the company was the equipment, and the another asset that was made as an exchange for that particular asset was our cash. Okay, so an asset account equipment is increased, resulting in a debit side. So when we purchased that particular equipment, okay, so we received a new equipment. That means to say that it increased our equipment asset. And the moment we made our payment, there is a certain amount of money that we let out from our company's pocket. So that is an outflow. So that means to say, our cash, which is an asset, is decreased, okay, because we made a payment for the particular equipment that we purchased. And for the fourth transaction, happened on the same date, the 3rd of January. A truck was purchased for $8,000. Big Dog paid $3,000 cash and incurred a $5,000 bank loan for the balance. Now, if we try to analyze these transactions, how many accounts do you think are involved for this particular transaction? Well, we have 3 accounts. Clearly, we have truck, okay, which is an asset. Second, we also have cash, which is another form of an asset. And finally, we have bank loan. Now, as you can notice in our debit side, our truck, which is an asset, is increased, resulting to debit. Again, if I may ask, why did our asset increase again? Because we purchased a truck. So the moment we purchased that particular item, we received that item. So we are now having the ownership of that item. So meaning to say, our asset increased. Okay, so that is why we debit the account. And also, if you can notice in our credit side, another asset, cash, is decreased, resulting in a credit. Now, since we paid 3,000 in cash, okay, for that particular equipment that we purchased, so there is a significant amount of money that we let out from our company's pocket. So that means to say that there is a decrease in our company's cash. So that is why, since your cash decrease, we need to credit the account. On the other hand, bank loan is also increased because out of $8,000, only $3,000 was the amount that we paid, but the rest is being loaned. Okay, so meaning to say that's a bank loan, and our bank loan also increased because that's our liability. Okay, so we need to pay that liability in the future. Okay, and take note that transaction 4 involves 1 debit and 2 credits, right? And notice that the total debit of $8,000 equals the total credits of $8,000 which satisfies the double entry accounting rule requiring that debits always equals the credits. And for the fifth transaction, happened on the 5th of January, Big Dog Car Works Corporation paid 2,400 in cash for 1 year insurance policy effective January 1st. Now, if we try to analyze this transaction, clearly there are two accounts involved. First, we have the prepaid insurance, and second, we have the cash. Now, as you can notice on the debit side, our asset account prepaid insurance is increased, resulting in a debit. Because the insurance provides future benefit, it is recorded as an asset until it is used. Okay? So that is why we record that one under debit side, because it increased our asset account. On the other hand, the payment of the insurance, which is the cash, results in a decrease in asset, resulting in a credit. So since we let 2,400 pesos out from our company's pocket, there is an outflow. So there is a decrease of our cash. And if there's a decrease in asset, we will need to credit the account. And the sixth transaction happened in the 10th of January. The corporation paid $2,000 in cash to reduce the bank loan. So if we try to analyze this transaction, there are two accounts involved. We have the bank loan and the cash. Now, for the debit side, this payment decreases our liability, which is the bank loan, resulting in a debit. So, meaning to say, since we made a payment of 2,000 in cash, so what happened to our bank loan? It decreases because the payment was made. So since our liability decreases, and if our liability decreases, we need to debit the account. On the other hand, the payment also decreases the asset, which is cash, resulting in a credit. Now, since there's a decrease, there's an outflow of our company's asset, the cash. So if there is a decrease in asset, we need to credit the account. And next, we have the seventh transaction, happened on the 15th of January. It says the corporation received an advance payment of $400 for repair services to be performed as follows: $300 in February and $100 in March. Now, if we try to analyze this transaction, the two accounts that are involved are, we have cash and we also have unearned repair revenue. Now, for the cash, as you can see in the debit side, our cash is increased at the time the cash is received, resulting in debit. Now, since we received an advance payment from our customer from the repair services requested from them, so there is an increase in our cash. Now, take note that if there is an increase in asset, what we do is to debit the account. On the other hand, since the revenue relating to this cash receipt is not earned as of this date, okay, so a liability account, unearned repair revenue, is credited because Big Dog owes the customers $4,000 of work. Because technically speaking, we have not started the repair services as of yet. So we still owe it to our customer. Okay, so that is why we recorded that one under credit side. And on the 8th transaction, happened on the 31st of January, a total of $10,000 of automotive repair services is performed for a customer who paid $8,000 in cash. So out of 10,000, we received $8,000 in cash. Now the remaining $2,000 will be paid by the customer within 30 days. Okay, or in 30 days rather. So if we try to analyze the transaction, technically speaking, there are three accounts involved, correct? First, we have the cash, of course. because we received a cash. Second, we have accounts receivable. Why accounts receivable? Because there was only $8,000 down payment. So meaning to say, we still have $2,000 receivable or collectible from our customers. And finally, we have repair revenue as well. Now, as you can see in debit side, take note that our cash is increased, right? Because we received $8,000 down payment from them. So that made our cash increase. So if your asset increase, then we will debit the account. And also, aside from cash, our accounts receivable is also increased, resulting in a debit. Since we have a collectible from our customers in 30 days, so that also increased our accounts receivable. And take note that accounts receivable is an asset. And if your assets increases, then we will debit the account. And finally, our repair revenue, which is under equity, is increased as well, resulting in a credit. So if your equity or if your revenue increase, then you need to credit the account. Okay. So the ninth transaction happened on the 31st of January. It says operating expenses of $7,100 were paid in cash. Rent expense, $1,600. Salaries expense, $3,500. And supplies expense, $2,000. $700 for truck operating expenses. We have oil and gas were incurred on credit. Now, if we try to analyze the transaction, take note that our operating expenses are divided into four, right? So we have our rent expense, we have salaries expense, supplies expense, and truck operating expenses, as well. And aside from these expenses, the other accounts that are involved in our problem, we have cash, of course, and we also have accounts payable. Now, on the debit side, if we try to analyze this, take note that this transaction increases four expense accounts, resulting in a debit to each. So as you can notice, we have operating expenses, a total of $7,100 were paid in cash. Now, since we paid $7,100 in cash, that means to say that there is an outflow of the company's money. We let a certain amount of money out from our company's pocket. So out of $7,100, $1,600 of it were paid to rent expense. $3,500 was paid on salaries expense. $2,000 of it was paid on supplies expense, and truck operating expense, which are the oil or gas, were paid on truck operating expense. Now, in that case, remember that these are expenses, and if your expenses will increase, then we will debit the account. Now, each expense, take note, is recorded in an individual account. It should be an individual account, not a general account like operating expense, because they have specific individual accounts. Now, on the other hand, on the credit side, cash is decreased, resulting in a credit. And how much is that? That's a total of $7,100, because that is the exact amount that we made, okay, to pay to our expenses. Because take note that that is the exact amount that the company made to pay its operating expenses. Okay, so that's an outflow. So if your asset will decrease, then technically it will be recorded as credit. And on the other hand, you also have accounts payability. And take note, accounts payable is under liability account. Now, since our liability is increased, then it will be credited. So that is why 700 is being credited. And finally, our 10th and last transaction, which happened on the 31st of January, it says Dividends of $200 were paid in cash to the only shareholder, Bob Baldwin. Now, if we try to analyze this, very simple, we only have two accounts involved. Of course, we have dividends and cash. Now, for the debit side, take note that dividend is an equity account, right? Now, since the equity increased, then we need to debit the account, which is $200. An alternate analysis would be that dividends cause equity to decrease, and that decreases in equity are always recorded as debit. And on the other hand, an asset cash is also decreased, resulting in credit. Why decrease? Because we made a payment to our shareholder, Bob Baldwin. So there is $200 cash that we left out from our company's pocket. So cash is an asset, and if we decrease our asset, we will record that under credit side. All right, as you can see on our summary of our transactions, we have their assets, okay, on my left side, equals liabilities plus owner's equity. Now, what we do here is that we actually specified all the asset accounts in our summary. As you can notice, we have cash, we have accounts receivable, we have prepaid insurance, we have equipment, and we have truck as well. Again, take note that these are all under asset accounts. Now, if you happen to notice, under cash account, you have their figures under debit side. You also have their figures under credit side. And each of these figures have corresponding numbers beside them, right? For example, for $10,000 under cash account, so you have their number one. For $3,000, you have number two, and so on and so forth. Now, take note that these numbered items refer to the transaction number, all right? So what you do here actually is account balancing. So you try to get the total of your cash under debit side, and you also try to get the total of your cash under credit side. So whichever has the higher figure, that is where you will put your sum, okay? Or the difference rather. Now, since the debit side has the higher figure compared to the credit side, so that is why we place our difference to the debit side or our balance, okay? So we have $3,700 for cash, plus accounts receivable of $2,000, plus prepaid insurance of $2,400, plus equipment of $3,000, plus truck of $8,000. So that would be a total of $19,100 for our assets. Now let's move on to our liability account. Now for our liability account, there are only two accounts involved, okay? Based from our first up until the 10th transaction. So we only have identified bank loan, accounts payable, and unearned repair revenue. So for the bank loan, our balance is $6,000. For the accounts payable, we have $700. And for the unearned repair revenue, we have $400. So a total of $7,100 for the liabilities. And finally, under equity, we have identified share capital account, dividends, and repair revenue as well. Now, take note that under revenue, okay, one of the components of the revenue is expense, right? So that is why we recorded these under repair revenue. So for our share capital first, we have 10,000. For dividends, we have 200. For repair revenue, we have $10,000 as well. Now, under each of these expenses, we have rent expense of 1,600, plus salaries expense of 3,500, plus supplies expense of 2,000, plus truck operating expense of 700. Now, if you wish to get the total of our equity, so the overall total, that would be $12,000. Now take note that in our accounting equation, again, what's our accounting equation? That's assets equals liabilities plus owner's equity. So your assets should be equal to the sum of your liabilities and owner's equity. Now take note that our assets is 19,100. So our liabilities and owner's equity, if you try to get the sum of 7,100 and $12,000, so that will be 19,100. So therefore, our assets is equal to our liabilities and owner's equity. All right, so that ends our discussion on our second key area. And the next key area that we're going to be discussing now, that would be the trial balance. Now, what do we mean by trial balance then? So if we say trial balance, it is an internal document that lists all the account balances at a point in time. Now, this means to say that the total debits must equal to total credits on the trial balance. And the form and content of each trial balance is illustrated in the next slide using the account numbers, account names, and account balances of Big Dog Car Works Corporation at January 31st, 2015. Now, assume that the account numbers are those assigned by the business. So as you can see in our sample trial balance, the company name is Big Dog Car Works Corporation, followed by the name of the statement. So in this case, we have trial balance, and we have the time frame or duration at January 31st, 2015. Now, if you can notice, in our first column, we have the account numbers. For the second column, we have the different accounts, okay? So for the third column, we have the debit side. And for the final column, we have the credit. Now, double entry accounting. Now, as you can see, the sum of our debit, that would be $27,100. And the sum of our credit side is also the same with debit, that is $27,100. Now, take note that double entry accounting requires that debits equal credits, okay? Now, the trial balance establishes that this equality exists for Big Dog, but it does not ensure that each item has been recorded in the proper account. Neither does the trial balance ensure that all items that should have been entered have been entered. And therefore, in addition, a transaction may be recorded twice, okay? Any or all of these errors could occur and the trial balance would still balance. Nevertheless, a trial balance provides a useful mathematical check before preparing our financial statement. And that happens to be our next slide. So as you can see, in our subtopic, preparation of financial statements, if you can notice in my left side corner, that is the trial balance, right? If you can see on the right side corner, that is the income statement. And as you can see at the bottom part, that is the statement of changes in owner's equity. So therefore, it is of paramount importance that when you generate your trial balance, you need to ensure that all transactions, all accounts are properly entered in the correct account, okay? Because this is our basis for the preparation of our financial statements. Now, as you can notice, okay, in the left side corner, we will focus first on the trial balance, okay? Now, as you can notice on the trial balance, you have there, can you run your eyes under first column account number? So account numbers 320 and 330. So as you can notice, a shared capital, okay, which is 320, and dividends, which is 330, are being transferred to the statement of changes in owner's equity. And remember, dividends is part of retained earnings because it is a distribution of net income. So why do we transfer them in our statement of changes in owner's equity? Because remember, okay, your equity is divided into two. We have shared capital and we also have retained earnings. And under retained earnings, we have dividends. So that is why we transfer this to our statement of changes in owner's equity. Now, on the left corner of our trial balance, okay, if you can see that accounts 450, 654, 656, 668, and 670, those are the last five accounts. We actually transferred these to our income statement. Okay, as you can see, you have their repair revenue of 10,000. Expenses, we have salaries expense, supplies expense, rent expense, and truck expense. Now, as you can notice, our net income, take note that in our income statement, there are two important keywords that we should always remember, right? We have revenues and expenses. And if we talk about income statement, the formula of income statement, that would be revenues minus expenses. So since your total revenue is 10,000 and your total expenses is 7,800, therefore the difference is 2,200. So whatever is the difference, that would be considered as your net income. And take note, your net income, 2,200, is being transferred to the statement of changes in owner's equity as part of the retained earnings, right? As you can notice there in the arrow. So you have there indicated 2,200. So overall, you need to take note, class, that for the preparation of the financial statements, there is actually a chronological order or sequence as to which statement or financial statement you should generate first, okay? So in generating the financial statement, you should generate first income statement. Why income statement? Because the result of your income statement or the net income will be transferred to the statement of changes in owner's equity. So that is why after generating the income statement, the next statement that we should generate is the statement of changes in owner's equity, because the net income result will be used in the next statement. And after generating the statement of changes in owner's equity, then the next thing that we need to generate is the balance sheet, because the result of your changes in owner's equity will be transferred to the balance sheet, and so on and so forth. Right, so that brings us to the conclusion of the discussion for our key area.